Fixed Income at UTI Mutual Fund. Amandeep, congratulations on winning the Best Debt Funders Award. So it'd be nice.
We follow here. In terms of our investment approach, I think original strategy of focusing on research-based decisions. So our research process focuses a lot more on investing in companies where there is a visibility of cash flows, where we have more reliance on our internal rating than relying on external rating, and that has helped us tide over several credit issues. We also have a very strong team which focuses on trying to anticipate market movements and position our portfolios accordingly. So we're not, because in India, and especially in fixed income markets, you have many mini cycles within the broader cycle. So you try and capture a bit of those moves and generate alpha, and that's, I think, what has helped us generate performance.
Sure. So we spoke about the interest rate cycles, and the broader sort of consensus that these are getting compressed, gently from a context. So how are you trying to address that when you're looking at your?
It's really been a big shift in terms of the way interest rate cycles are moving. They are becoming shorter because I think the economies are also now more prone to swings or those ups and downs, given what's happening in the rest of the world. So I think, like I said, our strategy has always been to try and anticipate these moves, and those are the ones which we try and capture. So I think we have a very strong base in terms of economic research. We have an in-house economist. We rely a lot more on global economic research from our strategic partner, which also helps us assess what's happening with the global economies and the world at large. So the combination clearly does help us in, like I said, formula sort of crunch cycles is that the investment horizon and obviously the holding period is also shortened,
right,
which is added to the overall churn in the portfolio. So the trading volumes have increased lately.
Okay. And the other thing that's obviously been making the news is that we spoke about credit, and there's been some stress around it. So just your take on how are you viewing this element of the market right now?
I think the credit stress was a follow-up of IMF's default, and I think for the Indian markets this was a very significant event, because in the past, wherever we've had larger financial institutions or companies default, they were very small balance sheet size, a few thousand crores at best. This was almost a 93,000 crore balance sheet default, and that did shake up the markets. We did see the first contagion or first round of effects on the NBFCs. That more or less has, in my view, moderated, because they were able to show their resilience, which was largely a liquidity crisis, not a solvency issue for these entities. I think the second round contagion is what we're seeing now, which is more in terms of lower risk appetite and obviously lower refinance.
Right.
Because a lot of investments or credit growth that we saw over the last 3 years was driven by the NBFCs. So now that they are being squeezed for funding, is leading to their inability to refinance or lend onwards, and that in turn has also led to some of the other issues that we've seen, whether it's in last kind of transactions or maybe some in the real estate space, because clearly the risk appetite which NBFCs had is not going to be replicated immediately by the banks. So we do see the second round contagion in terms of the refinance risk prevailing a little bit longer. Hopefully the markets will settle down, because we've seen some initiatives from the central bank. We've seen some initiatives even by the government to try and increase the liquidity in the system and ensure that you do not have any severe stress for some of these borrowers and some of these financial companies. So I think given a quarter or two, we see the lower interest rates, ample liquidity in the system, smoothing out any ongoing stress.
And in terms of just message to an investor, if you're looking to invest in fixed income markets right now, what should really be your focus on?
Sure. I think one thing I must point out, what has really happened over the last 12 months is clearly the real rates in India have actually increased significantly.
Right.
With the contained inflation, which is now clearly being targeted at less than 4% by RBI. We are looking at real rates even from the AAA quasi-sovereign issuers being as high as 400 basis points. Secondly, I think we must also look at the way the credit markets have evolved. Because of what has prevailed over the last 2 quarters, the credit spreads have also widened significantly. And this is true across the curve, whether it's a AAA, a AA, or a single A. So I think the combination of positive and high real rates, combination of the credit spreads being historically among the widest, offers a good opportunity for investors to look at short-term income funds, look at some of the low duration funds, and even credit risk funds. I think that's again a category which has borne the brunt of last two quarter of events. But in my view, since the pricing has corrected, it's again akin to some of the mid cap stocks having faced a bit of a sell off and now provide value. In my view, the credit risk funds are better managed, the ones which are not being swayed by the the market, its momentum and some of the exposures, I think can be looked at once again to add exposures.
Finally, it's all about risk reward, and like you rightly said, it's the reward is considered to the risk, and that additional that it doesn't.
Quite true, quite true. I think risk reward ratio does favor credit funds somewhat.
Sure. Amandeep, kudos to you and your team for the fantastic job that you've been doing, and congratulations.
Thank you again. Thanks to Morningstar as well. I appreciate this.